Hi all, welcome to Free Float. I am Sham and I have Kishan with me.
Hi
Kishan,
everyone.
uh, Kishan was down with the COVID virus last weekend, and we couldn't record our conversation for last Sunday, but he is fine and he is back, and knock on wood, nothing serious.
Yeah,
We had planned to talk about factor investing and what it means and so on. But maybe Kishan can start off with a brief history lesson as to what led to the current state of affairs and what it was before, like maybe in the 1950s or the 60s, and then maybe I'll jump in at that point.
yeah. So Sham, hi. It's good to be back. Yeah, and this is something that we have always wanted to get to. I'm to talk about factor strategies and to talk about history. So I think the history is more, you know, um, people with a scientific approach, because people who want to understand markets, not via their gut, but trying to find a more, uh, you know, trying to find an approach which makes sense. Like trying to find reasons why markets or a stock behaves the way it behaves, and you always had this, say from the most basic, like investing philosophy is like value investing, right? It's basically, I mean, all investing it's value investing when you are buying something which you think is like undervalued, and you're hoping to sell it at a much higher, at a much higher level, which is what most people say. Buy low, sell high, uh,
Hey, that's simple, right? That's how we make money in the markets. How do you make
yeah,
money in the markets? Well, number one, buy low. Number two, sell high.
yeah, and you can go back to say Benjamin Graham, who had a quantitative approach, to finding what is value. He had the net assets to the liabilities needs to be of a certain ratio. The P should not be more than 8. And a bunch of other things, which is a very quantitative approach. He did not go and say, I'll go find assets that I find appealing, or which I think will be the next GE and stuff. He went on a very quantitative approach, trying to define what value means to him, and he had his own filter and his own way of doing it. And I think from there you have a lot of philosophies and approaches, through many academic uh, uh, papers and stuff, which went to define what value is, you know um, and that I think is the most basic factor that there is, that so let's just so if you're talking about factors, you're trying to, what is a factor? A factor is what derives a, i mean I mean factors are what drives the stock return, and the multiple factors, right? So you have value, which is when a stock is undervalued, comes back to its mean, and that is one one driver of a stock return. And then your quality, the basic thing of quality is that higher quality companies would outperform lower quality companies. Then your growth, the market tends to reward stocks with a higher PE, stocks which are growing at a very at a faster pace. And then your momentum, which is either for a stock or the market, when the market loses, I mean, when the market is euphoric, and that drives the stock return. So you have many. I mean, these are the most basic factors that they are, but there are obviously other. There's some thousand factors I read recently that that people have, but these are the most basic factors. And what you're trying to do is you're trying to find stocks in each of these baskets. at any given point in time. So you're trying to define what is value, what is quality, and you're trying to define them. And so the history is basically people who have a very scientific temperament, trying to find a logical or rational explanation of why a stock moves the way it does, and then to breaking it down into different factors or reasons.
Right. So when I talk about factors to investors, right? So the first question I get asked is why bother, right? So as long as you buy a stock and it goes up, what difference does it make? So I think there's a
Diversification, right?
yeah, I mean there's a misconception that somehow if you do factor investing, it's somehow road to riches paved with gold or something like that. Yeah, factor investing in itself doesn't guarantee you anything, right? So to understand why we need factors and why academics came up with that idea, right? You need a bit of a rewind. So the best analogy I could come up with was how initially, right? People thought that everything sort of rotated around the Earth, right? It was called geodesic or something like that, right? So they
Yes.
assumed that all heavenly bodies, including the sun, rotated around the Earth. Earth was the center of the universe, and they came up with more and more complicated models to fit the trajectory of different bodies. So obviously you would want to say that, okay, in March, where do you think Venus is going to be? So you needed a model to kind of predict, okay, Venus is going to be in this plane and in this latitude, longitude, or whatever. So the problem with that Earth-centric theory and all the models they had built was that it just became more and more and more complicated to incorporate new bodies as and when they were discovered. So telescopes became more and more stronger. They could they could map more of the universe, and the more it mapped, the more frail this model became. So it went to a point where to describe the motion of one single comet, it would take like pages and pages of formulae to figure out what is happening, because the underlying model itself was crumbling. So that's when Kepler came in, and he said that there has to be a simpler explanation, right? And he spent a better part of his life coming up with a completely different model that actually says, okay, the Earth goes around the sun, and all planets do that. And then you have different, like the moon goes around the Earth, and just like how we have the moon, something else goes around Saturn, and so on and so forth. So his whole thing was that the model that was useful for the better part of 200 years no longer suffice to understand the new physical phenomena or physical objects that were discovered during that period. So my point is that as your measurements become more and more sophisticated, and you have more data gathering ability and more data analysis ability, the models also need to keep pace, right? So a certain simple model might be enough to describe um, 4 or 5 objects, but as you discover more phenomena, you need to have that mental flexibility to discard the old model and come up with a new one. And it was not like it stopped at Kepler, right? So Newton looked at Kepler's work, and he came up with his
Yes.
own thing to describe, okay, all this can be these laws can be described as mathematical and physical formulae. And then after Newton came Einstein, and Einstein said, okay, here's a bunch of so-called special theory of relativity, blah blah blah. And if this is true, then there should be black holes and dark matter or whatever, right? And then scientists built all this elaborate multi-billion-dollar magnetic loops and so on, particle colliders, to see if those black holes actually exist or not. And it was like some 50 years later that they actually said, okay, you know what, black holes exist because we collided these particles, and the phenomena described by Newton actually exist. So like this, there is a symbiotic relationship between your ability to observe what's going on, and a parallel stream that tries to build models to kind of help you understand your observations, right? So they go kind of hand in hand, and that's pretty much what happened in finance as well. So initially, just gathering data about the markets, knowing where a stock closed and where it opened, that itself was a very cumbersome process, right? There was a time before, in the like in the 60s and 70s, when a chart book was literally a book that was mailed to you at the end of every week with charts, right? People laugh at it nowadays when you say, plot a chart. I mean, it's like any kid can do. But back then, it literally meant, taking a scale and plotting it, and, taking it to the printer and getting it printed. So a lot has changed since then, and so has our ability to gather data and compute it and so on. And the models, initially, the biggest problem with financial models was, the limits to computation, right? It wasn't until the 70s that, financial data was actually available in a database. It was only in the mid 70s that, the Chicago School of Business actually came out with their database that they could, allow academics to sort of analyze financial data series. And and we are talking about like 70s, which is like the era of mainframes and mini computers, right? So most of the analysis that they could do was, just to make their lives simpler, they just did it on monthly data. So they were like, you know what, looking at this on a yearly, on a daily basis is too much work, too much computation overhead. Those were the days when, you had to like write your programs in punched cards and take it to the mainframe and all that stuff. So they said, let's just analyze monthly data, it's just easier. So the models that they used, this whole, efficient market theory and whatever came, from that, right, was basically because of limits to computation and data gathering. And they said, okay, if we just assume that everything, all the information that we know about a stock is immediately and instantaneously reflected in the price of the stock, then the math that we can use to analyze and build risk models, analyze and build, pricing models becomes a lot simpler, right? We can just do it with a slide rule if you wanted it. So that was probably the motivation behind making those simplifying assumptions that everything is, baked into the price. And and from that came a whole stream of, academic literature, right? So once you say, EMH, that I believe in EMH, then from that EMH, you can say that, oh, what exactly is the price of a stock then? It's just, it's market returns plus some error term, right? So if you have a portfolio, what we call alpha now for academics, it's an error term. It's error because, it's not a beta over the market, because, you're not supposed to be rewarded for taking for taking less risk or whatever, right? So your risk and reward is supposed to be proportional. So whenever it is not proportional, the extra term is just an error term. So what we call alpha, and we so kind of like, pride ourselves on excess returns and alpha. Academics used to call it the error term. So what happened was that, that whole model, that returns are proportional to market returns plus alpha, stood for almost 15, 20 years. So that whole CAPM model, um, was the centerpiece of academic research for a very, very long time. But the problem was that, the way I see it, it's a symbiotic relationship, right? If let's say I'm like $1 billion investor, and I have hired an investment manager to manage my funds, and I'll tell him that, look, I'll reward you based on the alpha you generate, right? Now, if you just say that, returns equals beta times market plus alpha, then I end up generating superior returns, and I'll say at the end of the year that you need to reward me for that. But what I think academics wanted to find out was that, is there something in the market itself, right? That was generating this error term, which is this large error term that we call alpha. So is there something intrinsic to the market? And I think, that was the genesis of all this factor investing and the pharma fringe factor, which is basically that, look, there is something in the market, right, which doesn't require a ton of skills, right? It's part of market beta, right? That managers can use and and systematically use, to make so-called excess returns, what used to be called excess returns before, and you can systematically do it. So that was the genesis of it. So once you have this, value factor and the small cap factor in, and plug it into the equation, the error term goes down, right? It can systematically go down. So now, as an investment manager, my so-called alpha, once you plug in your small cap and value factors into the equation, comes down. So I get paid less, right? So in the classic words, it's basically, today's alpha is tomorrow's beta, and this is what it is. It's like discovering new things about the market that's intrinsic to the market, and saying that, you should not be rewarded for something that can be systematically exploited. So if a computer can do it, then a human being should not be paid, for generating those returns. So that was I think the beginning, or at least the financial motivation for, factor research. And, there's a big difference between what academics call value and what the general population calls value, right? So, when somebody says value investing, they mean, it could mean anything. So it could mean, I expect this company to grow its revenues 5x, but the market thinks it'll grow revenues only 3x. So the market is undervaluing this stock. So as a value investor, I'll go and buy it, right? Because it's an undervalued stock. But that is not at all what academics think value is. When academics say value, it is statistical value. So a statistical value is basically, you take, book to price, take the returns of high book to price stocks, subtract it by low book to price stocks, and whatever spread you get is the value factor, right? And it's the same thing about small caps as well. So take the returns generated by, micro caps, take the returns generated by large caps, subtract it, and you get the, the small cap, factor premium. So these things from an academic point of view are spreads. These are not long only portfolios. These are not something that you can invest in, right? There's no such thing as just investing in the spread, right? I mean, you can do it. You can construct a long short portfolio, but most retail investors don't do that, right? They don't hedge away the beta. They don't construct a long short portfolio. So what the article shows is also the historical sort of annual returns of both the market as well as these spreads, right? So when you look at it, a big chunk of investor returns is coming from the market, a big chunk.
Yeah.
That pretty much determines your actual returns at the end of the day, what you can eat. But there is a small part of it which is value and small cap, right, and which fluctuates, right? So you have this big thing which determines 80% or more of your returns, and a small part of it which fluctuates. So you need to kind of understand that there is no such thing as pure factor investing for retail investors. When you invest in a factor portfolio or a factor strategy, a bulk of your returns is still coming from market beta. But over 10 years, right? If you persist on investing in, say, small cap premium, or value or quality or low volatility or momentum or something for over 10 years, that those fluctuations around that even out, and that spread that you're supposed to get shines through the market beta. So overall, I think they've estimated that it can add about 2% to 5% annualized returns, over your market beta if you over a 10-year period. But year over year they fluctuate quite a bit, and that's what I think. Hope the chart illustrates this point. But to go back to the history lesson, right? It's an evolving topic, right? So you observe something in the market, and you ask yourself whether this observation can be systematically incorporated into a model. If it can be systematically incorporated into a model, i.e. the long short spread of whatever factor you want to call it, value, quality, whatever, is stable, right? It's a persistent spread, then it is something that is systematic to the market. And if you invest in it over a very long period of time, you will become wealthy. But the key thing to remember is what academics call value and all these factors. They're all long short. They are long short spreads. So they are not long only portfolios that typically you and I buy off the shelf.
Yeah. So Sham, I mean, so basically, factor investing is, being rewarded for specific risk premiums.
Yes. And what those risk premiums are, I mean, you can isolate them to a certain degree, but we'll discuss this again, maybe next week or in the next post, that there's a lot of pollution between these.
Yeah, and essentially it's beta. I mean, it is another form of beta.
Yeah. So some people call it smart beta. It's a good it's a good marketing term, but in itself it doesn't mean anything, because you're not being very smart doing this for short time horizons. Yeah.
But then, do you think that if you have a value portfolio and if you have a momentum portfolio and you combine them into one portfolio, that portfolio would give you some benefit of say diversification, right? Because the both will do well in different market conditions. Like value would tend to do well, like in the last 3-4 months. I would think value would have outperformed like momentum, at least in India.
Right. So the problem is basically, first of all, you can't escape beta, right? So if beta itself is like 80% of your portfolio, then whether you have a value tilt or a momentum tilt only matters at the margins, Okay. Now, in terms of combining those two, I'm not a big fan of combining different strategies into one, because what happens is okay, in one environment value will outperform, and in another momentum might outperform. But if you add the two together, how different are you from just getting beta, right?
Yes.
So it just becomes an expensive form of beta if you're not very careful. So I would say that there are different techniques that allow you to time factors. And I would bet on those kind of strategies which are shown to be robust, rather than just combining them. Because if you look at the US experience, right? So you have Russell 1000 value, and you have Russell 1000 growth.
Yes.
If you add the two together, you get Russell 1000. So what's the point, right? Russell
Yes.
1000 is probably a 10 beep ETF, whereas these special factor ones end up costing you a bit more because of the branding and so on. So the question is, you have to be different from beta to actually make money. I mean, make those excess returns.
Yes.
But by combining a lot of factors together, you might just end up becoming beta. So I would be very careful about that.
All right.
All right.
All right.
So this post discusses the first step that Pharma and Friends took. So it's called the three-factor model. The first factor is the market returns. The second factor is the value factor returns, and the third factor is the small cap returns. So there's a lot of controversy about the small cap premium, uh, primarily because markets keep changing, market structure keeps changing, and some academics have pointed out that small cap premium is very small and can be explained by extremely low liquidity. So when you take just the monthly returns, and you take the mid price, you're not factoring in all the nonsense that goes on in small caps, which is low liquidity, low float, all that stuff. So when you incorporate those issues in past data, along with the high brokerage costs, um, that a small cap investor would have incurred in the past to actually run this strategy, it's no longer a strong enough factor to be a standalone factor, given current conditions. So quite a few people have pointed out that the small cap premium may no longer be significant in the US. So like I said, it's about observing the real world and building a model to understand the real world. And in finance, it's a complex, dynamic, adaptive system. Like I keep trying to impress upon people that your actions in the market ends up changing the market, and it adapts to whatever you're trying to do. So the minute somebody discovers something significant and publishes it, that in itself changes the market, right? So that also leads to a lot of factors kind of showing diminishing returns. So it's exciting because it gives you a theoretical framework to understand the markets, and also to measure investor performance. So, but at the same time, it's kind of like giving a bazooka to a kid, right? So investors should not end up hurting themselves, thinking they found something really awesome and become, something that will make them
Tech
next
investable.
What's that?
Like also, like I mean, like investable, right? Because small caps are not like always investable. I mean, you mentioned liquidity.
Right. So anyway, with that, we will sign off today's free float. If you have any questions, please ask us. In the mailing list. We'll catch you next week. Bye.
Yeah. See ya. Bye.